Okay, good afternoon, everyone, and welcome to our webinar on income of not-for-profit entities, looking at AASB 15 not-for-profit guidance and AASB 1058. I'd like to introduce today's presenters. So my name is Nicole Giles, I'm the AASB Technical Director, and I'm joined today by Carmen Ridley, who is a consultant to the AASB, and also Freddie Hauser, who is the AASB Deputy Director. And for those who may not be aware, Carmen is a recently retired board member, and we're very fortunate to have Carmen working with us on a number of projects at the AASB going forward. So just before we get into the detail for today, I'd like to run through a few housekeeping matters. So hopefully you can hear us all okay and see the slides. You should also be able to see the Q&A and chat button on your screens. So if you can use the Q&A button to ask any questions as we go through, and if you could use the chat button if you happen to have any technology issues or there's any other issue that you'd like us to attend to, we'll be able to see it through the chat function. So in terms of the technical content, just a reminder that we're not able to provide any comment or respond to any specific facts and circumstances. But if you ask your questions as we go through, we'll endeavour to answer as many as possible. We would like this session to be interactive, so we will have time for Q&A at the end as well. And as Freddie noted at the beginning, the webinar is being recorded and the recording will be available after the webinar. And we'll also have the slides available as well after the webinar for all the attendees. Just finally, before I hand over to Freddie, our usual disclaimer is that the presentation provides personal views of the presenters and doesn't necessarily represent the views of the AASB or other AASB staff. And the contents are for general information only and do not constitute advice. The AASB expressly disclaims all liability for any loss or damage from reliance on any information in the presentation, and the presentation is not to be reproduced, distributed, or referred to in any public document without the express prior approval of AASB staff. And now, without any further ado, I will hand over to Freddie to start walking us through the purpose and agenda for today's webinar. Thanks, Freddie.
Thank you very much, Nicole, and good afternoon, everyone. Well, from Melbourne. So this webinar is one of the outcomes of the short-term and narrow scope project that the AASB decided to undertake last year following the feedback received from stakeholders on the implementation of AASB 1058 and related not-for-profit guidance in AASB 15. On the back of that feedback, the staff conducted further targeted outreach to understand the prevalence of the issues in practice. And after the board considered the matters raised from the targeted outreach at its September and November meetings last year, it agreed with staff recommendation to develop further educational materials to the ones already existing, for example, not-for-profit FAQs that are already on a website, to further support consistent application of the standards, and perhaps to provide some signposts as to relevant sections and considerations in standards and when applying them, including illustrative examples and basis for conclusions, for example. The board also decided to address some of the matters through the proposals in exposure draft 318. That exposure draft was issued in January this year, and we'll talk about that one a bit later. Comment period closed just recently, and the board will consider feedback at its upcoming April meeting. Some of the proposals there, well, in particular, good news were around the initial measurement of the right of use assets arising from concessionary leases, where the basis for conclusion documented the board's decision to retain accounting policy choice to initially measure these leases or ROU assets at cost or fair value for private sector not-for-profit entities, that is. The feedback collected also through this narrow scope and short-term project will greatly inform and informs the PIR that we already started on AASB 1058 and 15. And later in this session, we'll be actually seeking your expression of interest to help us with that post-implementation review. So this is the agenda and what we would like to cover for today, next 90 minutes or so, less than that. Well, these are the topics that have been raised through that targeted outreach. And as you can see, those topics include considerations when applying accounting standards, including the scope and identifying which standards to apply when considering a particular type of income for not-for-profit entities. Not surprisingly, considerations related to identification of the sufficiently specific performance obligation. We'll talk about principal versus agent considerations and specific type of transactions, for example, upfront fees, capital grants, and grants in arrears, to name a few. We'll try to highlight the practical application considerations. Also, we'll talk about illustrative examples that are already available to help with implementation in the standards. So moving on to the next slide, the first topic we would like to cover is the application of the scope of the accounting standard. This slide illustrates, obviously, in a form of the decision tree, the consideration to take into account to determine whether the income or the income or revenue transaction of not-for-profit entities is in the scope of a particular standard before, for example, deciding whether it's in scope of AASB 15 or 1058, which might be, I think, the most important question entities are dealing with. But this is to remind participants that those two standards are not the only ones that are dealing with the income of not-for-profit entities, and we'll talk about 15 and 1058 considerations specifically a fair bit throughout this presentation. This flowchart is not provided to assist with accounting per se, but it's to illustrate what are the considerations that entities can take into account when determining which standard is applicable. Obviously, the flowchart is also not exhaustive. For example, if entity would have insurance type of the contracts, then it would apply applicable insurance accounting standards or standard. It's important to realize, so when we are talking about these standards, that there is a specific the scope of 1058 is specifically defined or limited to transactions where considerations to acquire the asset is significantly less than fair value, and principally enables entity, not-for-profit entity, to further its objective. So not all income transactions of not-for-profit entities would be in scope of 1058, as well as the scope of AASB 15 is limited in a way that it applies to contracts to customers, other than those transactions that are scoped out in paragraph 5. So I think the bottom line is to realize the particular scope of application of respective standards, and that there are standards that are already dealing with types of the income, for example, income from financial instruments, income from leases, as illustrated on the slide. So this FAQ is also included in not-for-profit staff FAQs, and we will provide the link, or link is provided in the slides shortly. Moving on to the next slide. This is obviously transpired, and not surprisingly through the targeted outreach, the decision whether the transaction is in scope of 1058 or 15 is one of the significant ones entities are dealing with. So we thought that it's helpful to maybe reproduce this flowchart, which is actually reproduced from the Appendix B of AASB 1058, and I think nicely illustrates the considerations to be taken into account. Again, a bit of caveat there. This is not necessarily exhaustive illustration, because it doesn't take into account voluntary services and capital grants. And does not also illustrate all or applicable standards. For example, if the asset that is subject to AASB 1058 requirements would be in the form of the non-financial asset that might be in scope in AASB 116. So, for example, then the AASB 116 would apply when recognizing the asset. So, what this slide also tries to illustrate is that, for example, entity may determine that the transaction is in the scope of AASB 15 through different ways or in a number of the circumstances. For example, first, if the transaction is just not in scope in AASB 1058 because the asset was not required at significantly less than fair value to further not-for-profit objectives, and at the same time is a contract with customer with sufficiently specific performance obligation, then AASB 15 would apply. Second possible avenue is if the transaction is indeed the one where the asset was acquired at significantly less than fair value to further not-for-profit objective, but as then entities are stepping through the requirements of AASB 1058, they may determine that the terms of the contract or agreement give rise to related amounts that would be recognized in accordance with AASB 15, and then it would then include, for example, assessment of the sufficiently specific performance obligations, etc. So really, there is a few questions that entity need to answer, and this is also, these questions are outlined in FAQ number 5, that again is in that not-for-profit FAQs document that is on our website. And it's really the answers to, was the asset acquired for significantly less than fair value to principally enable not-for-profit entities to further its objective, or does that transaction occur in contract with customer? Does that contract or agreement include sufficiently specific performance obligations? Is that contract enforceable, for example? And well, let's not talk about just about 15 and 1058. It also can be AASB 16 that entity may consider that transaction is in scope with AASB 16, but alternatively, the entity can start with the transaction in scope with 1058 and then determine that there are related amounts to be recognized in accordance with AASB 16 leases, for example. We'll mention on the next slide, or maybe a couple of times, that AASB 1058 operates on residual basis, and that's illustrated on the right-hand side of this flow chart. So it does require entity, once the transaction is in the scope of 1058, to determine what are the related amounts, other assets arising from the transactions that should be recognized under appropriate other accounting standards, and then what are the other related amounts, again looking at the requirements of other accounting standards. And then the excess between the carrying amount of the recognized asset over the identified related amounts would be recognized in P&L in accordance with paragraph 10 of 1058. Moving on, so for the rest of the session, we'll be focusing on the interaction between, well, requirements of the 15 and 1058 and interaction between the two. I would probably say that the AASB 15 is a criteria-based standard, and that was not necessarily written with not-for-profit entities in focus. And that's why also AASB has decided to come up with the 1058 and the Appendix F to AASB 15. And we'll discuss, and Carmen will be talking about shortly, how an entity recognizes revenue under AASB 15, and essentially it's about satisfaction of the performance obligations by transferring goods and services, but I will not steal Carmen's thunder. In contrast, as we mentioned, 1058 operates on a residual basis. We have also put up a key facts document which tries to summarize all of this on, well, we attempted one pager, but it's probably more like 3 pages, but still hopefully a succinct document for stakeholders to engage. And the link is here in the slides. So I'll now hand over to Carmen to talk through specific considerations when applying 15 and 1058. Carmen?
Sorry, Freddie, just before we hand over to Carmen, we do have a question that's popped into the Q&A. So the question, if I paraphrase it, is looking at the fact that all NFP grant-like funding is provided to NFPs principally to further their charitable objectives, but sometimes that funding is also for the benefit of the grantor's wider objectives. And I suppose the question is, are you able to comment on how that interaction might play out? Does it overlap? How are entities able to sort of unpick those two potentially competing aspects when looking at the scope paragraphs for 1058 and 15?
Look, I think we have some guidance. Well, there is some guidance in 1058, what it means to further entities' objectives. I think it's really dependent on agreement by agreement and what's written and what's implied. I would always approach that question from the obviously reporting entity objectives. There might be some implied benefits, but I think it's down to the understanding of the contract, and maybe one of the consideration is whether the entity is acting as a principal or agent in that particular case, and that will be probably another consideration I will be looking at, if that helps.
Cool. Thanks, Freddie.
I might just add to that before we move on to my section. And I guess when, as a board, we put that section in about you acquire an asset for significantly less than its fair value to further your objectives, what we were trying to make sure that wasn't captured then is if you had managed to pick something up, and at the time we were writing this was the time that Masters, the DIY chain, went under. So if as a not-for-profit you'd gone into Masters, for example, and managed to pick up bargain items way less than their fair value, but they weren't given to you because you were not for profit, you just picked up things for less than its fair value because I could have gone in there and done that, Freddie on a call could have. We didn't want that to be captured because that wasn't given to the not-for-profit to further their objectives. So that was part of the intention behind including those words around furthering of objectives, just to exclude some things that may not have been given in that context. So hopefully that just adds a little bit more to Freddie's answer on that as well.
Okay, so I think, Carmen, it is you.
Fantastic. All right. So if we start looking, and Freddie's given us some information about the fact that we do have 2 standards, and hopefully you're all familiar with the fact we do have 2 standards for income for revenue of not-for-profits. So what I wanted to do is explore, first of all, how we get into one standard or another. So Freddie used the terminology that 1058 is a residual standard. So that means you fall in there if you're not somewhere else. So let's have a look at how we get into AASB 15. So what we've got on the slide is 3 different criteria, if you want, that you need to meet in order to get within AASB 15. So I'm going to cover them at a very high level here, and then we're going to explore enforceability and sufficiently specific in a little bit more detail. Before we get into this slide, however, I just want to cover off, Freddie talked about how we would cover some resources that are available to you, and we'll see this as we go through the session. So I just want to highlight them. We do have 2 accounting standards. Within those accounting standards, however, there is a fair bit of guidance for you. So you'll see on this slide, if we look at that first column, I've got a reference in there, AASB 15.F12. So what that actually means is within AASB 15, there is an appendix to that standard. That appendix is a specific appendix for not-for-profit entities to try and help you with the implementation of AASB 15. So every time we see that reference with an F there, that means your not-for-profit specific appendix. Often we find that not-for-profits in particular don't necessarily trundle through to the very end of the standard, but I just wanted to make you aware that there is an appendix in there that is actually really helpful for you as you are doing this work. So that's what that reference there means. And we'll highlight some other things that are available to you as we go through. So the first thing we have to think about is the contract enforceable? Now, what do we mean by enforceable is that does the fund provider have the ability to effectively slam their fist on the table and demand a refund, or demand that you do the work, or there's some other mechanism in place that means that there is something that you have to give back for them? We'll explore enforceability in a little bit more. You can see I've got some examples there on the slide, and we'll look at some other examples. The real key is that the fund provider only has to have the ability to enforce. They may choose not to, and that's okay. But as long as they've got the ability to enforce, we generally would satisfy that enforceability criteria. The next criteria is that in order to be within AASB 15, and Freddie mentioned the fact that this was not necessarily written for not-for-profits, and that's because it's an international standard. So there are things within here that aren't necessarily directly relatable, hence that Appendix F that exists. One of the things, if I was in a for-profit situation, is if someone gives me money, I'm generally transferring something back to them. So in order to be within AASB 15, there has to be that transfer external to the entity. So if I'm giving you money as a not-for-profit, and that's really for you to run your operational day-to-day things, you're not transferring that directly back to me, you would fail this criteria. So am I giving you the money for you to transfer goods or services to an external party? Doesn't necessarily need to be me as the person who has given you the money. I can effectively nominate beneficiaries, but it has to be a transfer to somebody external to your organization. We talk in this standard about a customer. Now, who does that mean for the not-for-profit? The customer is always the fund provider. So regardless of who's getting the benefit of the goods or services, the customer in this terminology that we use within the standard is always the fund provider. A third criteria, which is where you're probably all rolling your eyes at me because this is the one that causes so many problems, is that terminology of sufficiently specific. So I know I'm transferring a good or service, but what is the good or service I'm transferring? Have I been told what to do? Is it sufficiently specific, and does it create a performance obligation? So what we mean by that, again, if I can use a for-profit example as a context, if I give money to a for-profit, I know exactly what I'm getting back for that money. The for-profit doesn't have the discretion to go out there and decide they'll give me whatever they want to give me. It's very explicit what I'm getting for that money I'm handing over. So when we talk about sufficiently specific, it's about how much discretion do you have? It's about how much are you being told about what you have to give back for that. And again, we'll look at some examples a little bit later on. So I just wanted to put together all of those criteria on one slide for you to see. You'll see there's some very big pluses in between those circles. That means that all of these criteria have to be satisfied in order to be within AASB 15. And as Freddie's mentioned, if we're not in 15, we're in 1058 as our residual standard. We did talk about some other standards, AASB 16, the leasing standard, for example. We're talking about only revenue that is in the scope of 15 and 1058 for the rest of this session. So if we move on and we have a look at why is it so important? Why do we care about which standard we're in? The reason it's so important is we have very different revenue recognition patterns depending on which standard we're in. So what I've tried to do is just show again at a very high level on this slide why we care. If we're in AASB 15, we've said that we've got a sufficiently specific performance obligation. And the way that 15 works is it says, that's great, you've got this promise, you've got this performance obligation. When do you satisfy that? And the way that we satisfy it is by transferring control of the good or service to somebody. Won't necessarily use the term customer because I've said that you won't necessarily be transferring it back to the person who has your customer, the fund provider. But when are you transferring that to the beneficiaries, if you like? It may be transferred at a point in time. So let's see what's on my desk. If my performance obligation is my pen, at the point I hand over my pen to you, I've transferred control. So that's at a point in time. Or it may be, if it's a service that you are providing, that I transfer it over time. So consequently, if I'm in AASB 15, I will either recognise my revenue at a point in time or over time if I meet certain criteria within the standard itself. If, however, I'm in AASB 1058, then what I do is I focus on what's the asset. Now, the asset could be the cash I've received. If I'm receiving cash up front, it could be a receivable. So have I received an asset that I recognise in accordance with the accounting standards? If I have, is there any related liability for that? And this was one of the slides that Freddie put on earlier. So is there a liability that I can recognise in accordance with the standard? If there is, I recognise it. For example, I've been given some land, and that land is actually really heavily polluted. So the only way that that land can be dealt with is by rehabilitating that land. So I was given it as a, here you go, have some land, but there was actually a huge amount of work related to that. So I would recognise a provision for that rehabilitation. Then I compare the asset that I've recognised with the liability, if any, that I've recognised. The difference between the two is my income that I record. So generally point in time recognition, and in many cases that is on receipt of the cash. There is an exception. That exception is a capital grant exception that we will talk about a little bit later. So that's our why do we care? Because potentially very, very different revenue recognition patterns. So let's keep working through some of the issues that were raised as part of this short-term project. The first one I want to talk about is in respect of documentation. So the question that we were asked is, what documentation should we consider? So we have lots of documentation, and I'll use the terminology grant. It's equally applicable to all of your income streams, but I'll just use grants. We have lots of documents relating to our grants. We might have the proposal document that we initially submitted to apply for the grant. We might have a master agreement that deals with all grants that we have with a particular government agency. We might have the specific grant agreement that deals with that grant. We might have project schedules. We might have variations. Lots of things that exist in relation to this income recognition. So the question we were asked was, do we just look at the one document that's called grant agreement? And is that where we base all our decisions to determine whether we have enforceability, to determine whether we've got sufficiently specific performance obligation? There is a lot of words on this slide. I know that, and you'll be pleased to know I'm not going to read them all to you. But what I wanted to do is show you where in the standard the guidance is around this. So you can see we've got references to appendices, we've got references to Appendix A, we've got reference to Appendix F. We've also got in the bottom two boxes references to BC. They are the basis for conclusions. So basis for conclusion is where the board has written down effectively why they made certain decisions, why they put certain things within a standard. So another good reference for you to look at, and often is an area that is not looked at by a number of entities. So you can see from all of this information, we don't just look at the grant agreement. We have to look at all of the things that work together to actually form that enforceable contract. So what I find when I work with not-for-profits is can be quite challenging to actually find all that information and put it together. But often the information in the proposal or the tender document really is sufficiently specific, because you've set out exactly what you are going to do if you are successful in winning this grant. The grant agreement, however, may be a little bit more vague. So the two of them together, we may be able to get to our sufficiently specific. So the key message from this slide is please make sure you're looking at all the relevant documents, because you may need multiple documents to help you make that decision. So let's look at sufficiently specific. Unfortunately, I'm not going to be able to give you a miracle answer to tell you exactly which grants are sufficiently specific and which grants aren't. But what I'm hoping I can do is at least give you a little bit more guidance and some things to be thinking about. So the reason that sufficiently specific is so important is we've just seen it's one of the criteria that we have to meet in order to be within AASB 15. So if we don't have a performance obligation that is sufficiently specific, we can't get there. As I've already mentioned, sufficiently specific is about how much discretion do we have as a not-for-profit entity to spend the money that we've been given. So what services am I providing back to the community? Can I choose, or is it very explicit either in my proposal document or in the grant agreement? The more discretion you have about the particular goods or services that you are providing, or how you are going to satisfy the overall objectives of the grant, the less chance that the contract contains sufficiently specific performance obligations, because you've got too much judgment, too much discretion around that. The lower the level of discretion, the more chance that it contains sufficiently specific performance obligations. So a good way of thinking about it is, okay, well, I've got this money, what do I have to do with it? And often I read grant agreements and the associated documents, and I ask the not-for-profit at the end, and I say, I've read it and I don't know what you have to do for the money. And they say, well, yeah, we can pick and choose what we do. Well, the more you can pick and choose, the less chance we've got sufficiently specific obligations. So if we look at some of the ideas that we've got in there, and Nicole's just popped up, so I have a feeling Nicole's got a question for me before we move on.
I do, thanks, Carmen. And it does relate back to your sufficiently specific performance obligations. So the question that's come in is, a lot of not-for-profits do run programs to carry out specific activities. So an example is an outreach program for marginalised youth. But within that program, there's a number of different things that the NFP could do. The activities are all part of the NFP's objectives. So if there's a funder, so for example, the government, who gives the money to the NFP to enable the NFP to run one of those programs, and without that funding, the activities couldn't take place. And the specific activities to be delivered, I guess, within that program are at the discretion of the NFP, based on whatever the beneficiaries need. Are you able to touch on how an NFP would be able to assess whether that's sufficiently specific, and whether that entity would be able to recognise revenue over time?
Yep, so I might actually flick on to the next slide, and we might cover it in the context of some of the words we've got on there. Yep. Unfortunately, it is one of those it depends answers, and it very much depends on the wording within the agreement. So if we use your example, so the example that's come through is specific outreach programs for marginalised youth. So if I said to you, here you go, have some money, we just need to help this particular youth population, do whatever you think needs to be done, that probably will not meet my sufficiently specific, because it doesn't include any information about what's the nature of the work, what kind of value, how many sessions do I need you to run, how much should each of them cost, doesn't give a period of time. If, however, I said to you, okay, well, I'm going to give you this money, the population we need you to help is the marginalised youth, it's a 12-month program, and I need you to be running programs that will help with bullying, that will help with drug education, that will help with alcohol, that will help with whatever's going on in the family, running via sessions, running via activities, etc. You can see that I'm giving you more sufficiently specific information around that. Now, you're probably going to tell me, if you were speaking to me rather than we're communicating via our Q&A box, that's probably somewhere in between the two. So it comes down to a judgment call. It is absolutely a judgment around this. So it could be that you have put in your proposal what you do. It could be that you've had to submit a budget, and that budget had to be approved by the fund provider, and that budget set out exactly which outreach activities you were going to do, that you were going to run this many sessions in these particular areas. It could be that it was very clear that there was a curriculum that had already been developed, and that's what you were running your sessions in relation to. So it's very much a depends answer based on what is there. What I would suggest is we look at those 4 different areas: the nature, the type of the work, the cost, the value, the quantity, and the period of time. Have a think about it. Document your ideas and have a chat with your auditors, if you are audited, about this, to see whether they believe that you are within the sufficiently specific criteria or not. Unfortunately, I can't give you an answer because I'm not reviewing your agreement. What I can tell you is, if the only thing says, here's some money, spend it next year, period of time isn't enough. We need to have more than that, but a judgment call around how much more do we need to have. So this is the area that we got the most concerns about, and people find this area the most confusing in relation to this. So when Freddie talks about post-implementation review a little bit later on, this is absolutely top of the list for looking at that post-implementation review, because we are aware that it is causing confusion.
Thanks, Carmen. There are a couple of follow-up questions, if that's all right to touch on those now. So the first follow-up question is, say for this entity that we're talking about for the NFP with the marginalised youth, say that entity must ultimately accomplish a specific purpose. Is that purpose not a performance obligation? Is the first follow-up, if you want to touch on that one first.
So I'm assuming by the purpose that the writer of the question means assisting with marginalised youth. It's not. Unfortunately, that is a too wide an objective, and we do address that within the standard, and we say that objective alone isn't sufficiently specific enough. So there has to be some more granular requirements that the not-for-profit needs to do for the funding that is being received. So a generic assist marginalised youth will not meet the definition of a performance obligation.
Thanks, Carmen. And then the second follow-up question, I'll take it as a question rather than a comment, is that when it comes to a judgment call, wouldn't it be fair to use a principle of just matching of expenses with income?
I guess we're very aware that matching is something that not-for-profits really would like to do it in a number of situations. Unfortunately, the concept of matching is not something that is explicit within these standards. So we have to very much say, if we need to look at which standard we get into. From 15, if we're in 1058, if we do get within 15, so it's sufficiently specific and it's enforceable, then the cost expenditure method is absolutely aware of measuring the revenue, but we have to get within 15 to be able to do that first of all.
Thanks. And just one more question on the same topic. Given how important this concept is for NFP entities, I guess it's more of a request as to, well, why didn't the board provide a more clear explanation in the standards on the kind of information to support what we mean by sufficiently specific in terms of performance obligations?
Yeah, and look, I think that's a fair call. It's very different, I think, when you write a standard and you think there's enough guidance in there, and it's only when we actually see it practically applied that we realise that possibly there could be some more guidance in there. So absolutely fair comment, and we'll take that, and that's what we're consistently hearing. So we do acknowledge that it is an area that people aren't necessarily being able to slot easily into work out whether they are sufficiently specific or not.
Cool. Thank you.
So let's move away from sufficiently specific and look at the other criteria being enforceability. So the question that we were asked in relation to enforceability is around refund clauses. And a number of not-for-profits raised the question that, is a refund clause sufficient to demonstrate enforceability? Because they had received some guidance from their auditors that even though there was a refund clause in there, the auditor felt like it needed to be more than just refund the money that you've got. So again, I put the relevant paragraphs from the standards in here for you to consider. What we've got to look at is, as I mentioned in the introduction, the person providing the funds has the right to slam their fist on the table and say, this is what you have to do because I have the right to be able to make you do something. So when we're looking at this, it can be legal means, it can be some sort of equivalent means, and particularly in the public sector, if we've got any public sector entities in the audience, often that legal is not an avenue for you, particularly if the money's come from different levels of government. So is it legal means? Is it some other equivalent means? The challenge that we do have is within the standard, it does acknowledge that the agreement can be written, that can be oral, or can be implied. So it's much harder to prove enforceability if we've got an oral agreement or an implied agreement. So there are, again, some guidance within the standard, some things to be looking at when we're trying to consider enforceability. So if we have a look at some of the examples that we've got within the standard around enforceability. So I pulled this again from an appendix, so therefore for you to see. So we've given examples of terms, and I'm going to work my way around the tree. So you can see at the very top of the tree, I've got a refund in cash or in kind where the agreed performance has not occurred. So when we're looking at a refund, we're looking to say either you haven't spent all of the money that I've given you, and in which case you need to refund that back to me, or you've spent it incorrectly. And I can say, I gave you that money, I get that you've spent it, but you haven't spent it on what you were supposed to. So when we're looking at refund, we've got those two different elements there. So if they exist, absolutely that is enough to say that it is an enforceable agreement. We'll go down the left-hand side of the tree. The customer or a party acting on its behalf, remember our customer is the provider of the funds, has a right to enforce damages. So again, probably a legal mechanism, but in the public sector, it may be some of the ministerial type direction. We've agreed on an alternative use. So if we haven't actually done what we're supposed to do, or it's changed what we need to do, there has to be some sort of agreement there if the other party has the ability to pull that asset or to agree that it can be used in a different way. If we go over onto the right-hand side, the customer has the right to take a financial interest in the assets that were purchased or constructed by the entity under the agreement. So they haven't done what they're supposed to do. They might have built a building, but the customer has the right to take an interest in that rather than force them to sell that. Could be forcing them to sell it, but also they've got that financial interest. And then that one at kind of 1 o'clock is specifically for the public sector. So where we've got some sort of administrative process there. So a fair number of ways we can demonstrate enforceability. It doesn't need to be just a refund. So refund is the easiest way, and I've reviewed a significant number of agreements. The majority, I won't say a vast majority, but the majority of them do have that refund clause. So it's generally relatively easy to tick off that we've got that enforceability. If we don't, it doesn't mean we don't have an enforceable contract. It just means we've got to look a bit harder to try and see whether we do have an enforceable contract or not. So we're going to move away from the criteria a little bit, and we're going to look at capital grants. We're going to look at a couple of particular scenarios. Now, when I talked about the criteria for AASB 15, we talked about that if I was giving you some money and that money was not for goods or service to be transferred outside of the entity, then you couldn't be within AASB 15 because that involves an external transfer. So there's some specific requirements to do with capital grants within the standards. We're going to explore that. So if we look particularly at the issues that were raised, the first issue that was raised was there's criteria within the standard to meet a capital grant exception. It's not called a capital grant exception within the standard. It's called where you've acquired or constructed an asset for an entity's to be controlled by the entity. Bit of a mouthful, so I'm just calling it a capital grant exception. And one of those exceptions says that there has to be an agreement where you will construct a non-financial asset. Non-financial asset, think infrastructure, property, plant, and equipment. That non-financial asset has to be constructed to identified specifications. So the question that we were asked was, what does that mean? How specific does an identified specification need to be? Now, we considered that as staff. We took this to the board, and it was decided that that clarification and a real detail on what did identified specifications mean was probably bigger than the scope of this short-term narrow scope project. So again, Freddie will cover in more detail a post-implementation review that's going to happen. That's absolutely on the list for that post-implementation review. So at this point, it is still a judgment call around is it detailed enough to tell you exactly what you need to build, or is it just buy an asset? Buy an asset wouldn't be identified specifications. The next question, which I am going to explore more, is how do we recognise income for the contracts which fall within that exception? So as I say, it's called assets controlled by the entity. We've got the paragraph numbers on here. The paragraph numbers relate to 1058 because, as we've already talked about, we cannot be within AASB 15. So we've received money, and that money requires us to acquire or construct a capital asset. So something that will be put onto our book. So we will be recording that generally through property, plant and equipment register, fixed asset register, but it doesn't have to just be limited to property, plant and equipment. So that's the first criteria. The second criteria is that the agreement says that we don't have to transfer that asset to anybody else, hence sat on our books. The third criteria is that the arrangement is enforceable. So we've just explored what enforceability means. We understand whether we've got an enforceable agreement. If we meet each of those three criteria, then we're able to use this capital grants exception that we have. So let's have a look at what that means. Within the standard, we have some examples. So within 1058, you've got the standard. And if you flick behind the standard, you will see that there are some illustrative examples. So what I've done here is I have pulled out the two examples for capital grants. It's exactly the same information that's in the standard, but I thought if I worked through it and you heard it explained, it's often easier to understand than when you're just reading it. So we've got two examples that illustrate quite different models. The first example is my entity has received $2 million worth of cash, and with that money, they have to build a 2-room early learning centre. It's on, we'll assume I'm the entity, it's on my land, and there are specifications on how that early learning centre has to be set up because we have government regulations about those early learning centres. If I don't spend all of the money, if I don't spend all of the 2 million, once I've completed my early learning centre, I have to repay the government any excess amount. And if I decide within the next 10 years that I'm not going to use it as an early learning centre, I will have to reimburse my funder on a pro rata basis. My intention is that I will keep using this as an early learning centre for the next 10 years. So I don't have a liability at this point because I'm not intending to stop using it. So it's something that I would consider. Potentially, I would consider whether I disclose it as a contingent liability, depending on which probability level I decide that that's in. So at the end of 30 June 2000X2, so 12 months after I received the money, the construction is 60% complete, and I've spent $1.2 million of the fund. I finish it a year later, so I finish it 2 years after I receive the money, and I spend all of the $2 million. So when I look at those criteria, I received a financial asset being cash to construct a non-financial asset being my early learning centre. The early learning centre is going to sit on my books. I'm not transferring it anywhere else, and I deem that it is an enforceable agreement. So let's have a look at my journal entries and how I actually account for this. On the day I received the funding, what the exception allows me to do is to say, even though you're in 1058, we will allow you to effectively have the same treatment as if we were in AASB 15. We will recognise that you have an obligation in relation to that money. Even though you're not transferring the building anywhere else, we'll allow you that same accounting, and the accounting is set out in 1058. So on day one, I received the cash, my debit cash. The credit is to an obligation on the balance sheet to recognise the fact that I have a liability in relation to that money. I have to build the building. As I do the work, because the building is on my land, I get the benefit of that work as it progresses. I don't need to wait until the building is complete because I'm getting the benefit as that construction is happening, because I don't need to then redo the construction if anything happened to it. So as the work progresses, I reduce the obligation that I've got for the amount that I've spent, and I credit income. So I take it out of the obligation and take it to income because I'm fulfilling the work that I need to do. At the same time, I'm also creating capital work in progress. So I'm recognizing that I'm building my building and I'm spending money to do that. Once I've completed the building, I will have spent everything, because in my example, I deliberately wrote it, so I spent everything. So spent everything. So I have no obligation. I've recognized $2 million worth of income, and I would have capital work in progress of 2 million that I then transfer to my property classification within the fixed asset register. So that's how I deal with this construction. I'm benefiting from it as we go, and therefore I would recognise the income on that basis. So that's example 9 from AASB 1058. Let's explore an alternative to that. So the alternative within the standard, did you want a question now, Nicole, or do you want me to do example 10?
Maybe do example 10 first. I'll come to it.
Cool. So the second example is where instead of constructing an asset, I'm acquiring an asset. So this example in the standard is where my entity has received some funding to purchase intensive care hospital beds. So those beds, again, are going to be used by the entity. They are not going to be transferred to anybody else. And I'm making the purchases in 2 stages. So I buy some beds and then I buy some more beds. Again, I've worked through the criteria and it is deemed that I meet that criteria and I can recognise the income as I complete the obligation. The previous example, I did it over time because I was building my building and I was benefit from that. When it relates to purchase of an asset, I get the benefit as the asset is purchased. So on the day that I take control of those beds. So you can see on day 1, I haven't purchased any beds. So the same as what we did for example 9, we debited cash, we credited an obligation. When I go out there and I purchase the 6 beds, I recognise the fact that I've completed 6 out of 16th of my obligations, and I remove that amount from the obligation and recognise the income. We also, on the other side, debit my equipment, credit cash. When I've completed my purchase and I've bought the remaining 10 beds, do exactly the same thing, but for the 10 beds rather than for the 6 beds. So consequently, I've done everything I'm supposed to do. I've spent all my money. I've got the relevant amount of equipment of $100,000. I've recognised income for that $100,000. Don't have an obligation, and I've spent all my cash. So that's how we deal with our capital grant exception within AASB 1058. Did you want to jump in with your questions now, Nicole?
Sure. So first question, well, this question is touching on, I think it's example 9. So if we've got funds that are given to construct or purchase an asset and the contract is enforceable, it's AASB 1058, so the asset exception. The unspent money is recognised as a liability. However, in the case of the same scenario, but the funds are given to do specific works on just repairing an entity's controlled specific assets, so it's not going to be capitalised or added to existing assets. All funds received should be recognised as income in year 1 under AASB 1058, even if there are unspent funds at the end of year 1. Is that correct?
That is correct, yes. So this exception only exists if it will result in a non-financial asset that will sit on your balance sheet. If you are spending the money on repairs or spending it on operational things that will not result in an asset, you do recognise that revenue on day 1.
Thank you. Unrelated, but same question on example 9. So in example 9, we've got 60% completion as being equal to 60% of the spend. So that highlights that you could recognise income based on the money spent rather than the actual stage of completion. Are we able to confirm that the income should be recognised to the extent to match the progress of the build rather than the amount spent?
So it would depend. Under AASB 15, which is effectively the accounting we're doing, even though we're in 1058, you've got the input and you've got the output method. The input method is based on costs incurred if you think that's of a reasonable stage of the progress. The output method is based on the progress. In the private sector, they quite often do, in the for-profit sector, they quite often do output method because they'll get quantity surveyors come in. In the not-for-profit sector, what I generally see is it's based on costs because you don't necessarily need to spend the money to get a QS to come in and say how far through you are, because it's something that you benefit from rather than incurring an extra cost. So you can use either method, whichever one is more appropriate for you.
Cool, thank you. That's everything on those examples for now.
Fantastic. All right, so the last area that I'm going to cover off before I hand back over to Freddie is in relation to upfront fees. Now, the question that we were asked around this is where an entity does receive upfront fees, and that is payments for, it could be, as you can see from the slide, it could be joining fees, it could be enrollment fees, it could be some sort of setup or processing fee, a fee that you get up front before any work has been done and that doesn't necessarily relate to a performance obligation. There are some staff FAQs. So this is another area of resource for you. There are some staff FAQs that currently exist for particular scenario being not-for-profit private sector schools. Staff FAQs are not authoritative, so they are the views of staff. So it can help as additional guidance, but they don't form part of the standard. So what we were asked to do is possibly move away slightly from the very specific scenario of a school and give a more generic example. So if we have a look at the outcome from this project, on the next slide, please. What we have proposed within ED 318 is a more generic example. So we've talked particularly around an entity, and we haven't specified what type of entity is. We've specified where there is an upfront fee that is paid that is for ongoing services. We've looked at how we consider how we account for this particular fee. So in this example, it's non-refundable, it's non-transferable, it's not offset against any future fees. You pay this one-off fee and it allows you to have access to those ongoing services. So we've described the scenario within the exposure draft, and then we've given some guidance around that. So if we have a look at the next slide. So some of the areas we've said to think about. The idea of this example is not necessarily to give you an answer, it's to give you a thought process. So if you do incur these upfront fees, you can start working through the same process. So we have to think about, is the contract within the scope of AASB 15? So we've worked through that sufficiently specific performance obligation. We've worked through whether it's enforceable. We understand whether the contract as a whole is within AASB 15 or not. If we are in AASB 15, which is where this is relevant, we then have to consider what are the performance obligations? What are we promising to do? And what was the upfront fee for? Was that for something that forms a separate performance obligation, or was it something that effectively forms part of the overall performance obligations, being access to services, for example? So can we separate out what we paid for or what we received when we paid for that upfront fee compared to the performance obligations? Based on the answers to those two questions, we can then start working out how we recognise the upfront fee. So if we're effectively saying that the payment of that upfront fee and the goods or services that we provided in relation to that are a distinct performance obligation, then we unbundle it and we deal with it separately. In many cases, what I see in the not-for-profit space is it's not. It's effectively forms part of this one performance obligation. And what we do is we recognise that upfront fee revenue over the life of the service that we are providing. It's not the case all the time, but certainly is the case in many times. So that example hopefully works you through a little bit more of a process in how to deal with our upfront fees. So that was all I'm going to talk to you about today. Nicole, is there any other questions before we move back over to Freddie?
Nothing at the moment. We've got a couple we'll come back to at the end.
Fantastic. All right, over to you, Freddie.
Thanks, Carmen. So now onto maybe somewhat contrasting topic to the upfront fees, and that is the grants received in arrears, and in particular considerations associated with the question whether the entity have rights under the agreement to recognize the asset given the work performed to date, and possibly then recognize associated liability and or income under 1058. Under transactions in 1058, that recognition of that asset received is relatively straightforward because it's clear that the entity controls the asset that is subject to the transaction. For example, it already received cash, and I think that was the main illustrated by the existing illustrative examples in 1058. 8. However, during that targeted outreach and in the discussion with the stakeholders, there is a number of scenarios where entity will already do some work, however, has not received the asset, say for example cash, as yet. And the question is, for example, by the reporting dates. And the question is whether, in that case, entity has a recognizable asset to put on a balance sheet, because, for example, it met all eligibility criteria, but only maybe for the proportion of the transaction. And then the question is, should the entity recognize the asset in full at outset, or on pro rata basis, or possibly at the end once all the eligibility criteria for the whole transactions are met? So as we discussed, AASB 1058 is a residual standard, and since essentially entities are preparers to the requirements of other relevant accounting standards to assess whether there is a asset to be recognized and measured. As in all circumstances and transactions, entity has to assess a particular facts for that particular transaction. And in that, entity can, for example, consider whether it has a financial asset under AASB 9. And if during that consideration, or while making that consideration, it's essentially assessment whether the entity has a contractual right to receive cash. And whether that right then, under being the contractual right, whether that has a clear economic consequences that is enforceable by law, and other party has little, if any, discretion to avoid the transfer of the asset. And the words what I would just mention were the definition of the financial asset and liability from the AASB 9. But I think it's important to remind stakeholders and attendees that when you are assessing requirements of 1058, inadvertently or well unavoidably, you will venture out into the other standards. So, and then in some cases it may be possible that entity have the rights, for example, receivable, and then entity would then consider other requirements of 1058 in terms of the related amounts of in income. We try to illustrate this type of the scenarios in already mentioned document, not-for-profit FAQs. I will just remind again what Carmen already mentioned, that these FAQs are staff FAQs. They were not necessarily reviewed or endorsed by board, so and didn't go through the same quality purpose review purposes and public comments. So they are not the standard, and they cannot interpret standard, but hopefully they are helpful. Moving on, another area where stakeholders made a number of comments that it's hard to apply and maybe creates confusion in not-for-profit sector is the principal versus agency assessment, and then resulting accounting treatment, whether to recognize assets and liabilities, and then income and expenses, or on net or gross basis. On this slide, we have listed number of circumstances or example where that consideration may come into play. We are not necessarily going to give full or any magic answers. I think Carmen referred to it, because again, every transaction and agreement needs to be assessed considering its particular facts and circumstances. But some of the examples are, I think, those situations where entity may serve as a funnel to receive funds, but then pass them on to some other entities for them to achieve their objectives. So I think there are some national disability insurance scheme arrangements, and then those consortium types of grants and national bodies in some kind of group situation. Obviously, again, I will repeat it again. 1058 is if the transaction is scoped in 1058. 1058 is a residual standard, so it will be the other standards that should or could provide the answer to that question, as well as conceptual framework does have a consideration around principal versus agent and control of the asset. However, AASB 15 does have guidance on principal versus agent assessment, and that's specifically in paragraph 8 and 9. Let me check that. and paragraph B 34 and 38 in AASB 15. And essentially what that guidance is about, the entities are determining whether it's in control of delivery of the goods and services to customer, being the performance obligations and then entities in the principle, or whether it's arranging goods or services to be provided by another party, and in that case the entity would be an agent. The AASB 15 and those paragraphs that I mentioned also list some considerations that can be taken into account to determine whether the entity is in fact in control of those specified goods and services before they are transferred to customer. And some of them is, I think, whether the entity is primarily responsible for the delivery, whether the entity has inventory risk, and whether the entity has a discretion at establishing the price. So I think these are just a couple of considerations when looking in the principal versus agent. And as we'll talk shortly, this is, I think, one of the topics whether they need more guidance, specifically in 1058, similar to other comments, I think, from stakeholders that have been already made in this session. So moving on to the termination for convenience clauses, which is the area that actually was raised even prior we started the narrow scope project. As entity were going through their contracts and agreements, they identified that there are some clauses, I think especially in the government grants, but may others, and these clauses are also exist in for-profit space or sector. And it's essentially the liability, where the question is whether the liability should be recognized for funds not yet spent when the grantor has right to call the funds back for their convenience. Staff brought the analysis of that question to the board, I think in November 2020, and board did not make a decision because in accordance or in line with the due process framework, would need to refer, or that question would need to be referred to IFRS Interpretation Committee because it does impact for-profit sector as well. And I think this is one of the areas where that will be considered as a PIR, because I think it talks to the boundary between 1058 and other standards, and whether there are clauses in agreements that are actually giving rise to particular assets or liabilities in the scope of other standards, and whether, for example, in this case, it's AASB 9 or AASB 132 or something else. And I think that's the area where entities might be looking at some further guidance, because those contracts were not necessarily set in a way to maybe explicitly contain this type of the say financial instruments, but there might be. And for example, and again, that's one of the functions of AASB 1058 operating on residual basis. It's also important to realize, moving on from 1058 to AASB 15, that there is a relatively clear, I think it's clear guidance or requirements about the scope of AASB 15 and interaction with other standards. And for example, for financial instruments, the entity needs to take into account those requirements, and if the contract is, for example, in scope of both 15 and a 9, then entity needs to allocate the transaction price accordingly to the interaction between those two or more standards. So I think it's important to go through and go back to AASB 15 scope if that's the case for this type of the contracts and termination for convenience clause, to see how that interaction of the standard works. But hopefully also the staff paper, obviously that's just staff paper, it will not provide any authoritative guidance in any shape or form, but could contain useful considerations when dealing with these type of clauses. Moving on to the exposure draft that we already mentioned a couple of times, 318. So there are a couple of elements to that exposure draft, and we mentioned that those are the matters where the board decided to address through exposure drafts rather than educational materials such as this webinar. And one of them is the example in 1058 around the cash scholarship endowment. So it's example 3A, where stakeholders raised comments or concerns that the example was potentially unclear, as it doesn't necessarily sufficiently explain how the financial liability, whether financial liability is recognized under the illustrated scenario, and for what portion and how is they recognized. So to respond to those concerns, the board has issued a proposed amendments to the standards and amended scenario, and therefore conclusions, and added further clarifications on the recognition of the financial liability and the measurement. And also board proposed to provide a contrasting example where the financial liability would not arise. The comment period for this exposure draft closed on the 11th of March, and we have received a fair bit of feedback on this example. So we are just at the moment assessing, staff is assessing the feedback before coming up with a recommendation to the board how to progress or not with these examples. And I think it's and those submissions are publicly available. So if you look at them, I think there is a fair bit of comment from stakeholders to leave a number of these considerations to post-implementation review, because it does range on the principal versus agent consideration assessment, and depending whichever way that example would go, it may significantly impact current practice in terms of the recognition of, say, for example, income on net or gross basis. And again, in my personal view, that type of the change should not necessarily arise from the change in illustrative examples. So there might be some unintended consequences. So that's something what board will consider at its meeting in 2 weeks, and we'll decide on the next steps. Staying with the 318 exposure draft, in terms of the concessionary or peppercorn leases, and already touched base on that. I think that's a good news for the not-for-profit private sector, at least, where the board documented its decision in the basis for conclusion to that exposure draft to maintain the accounting policy choice to initially measure right of use assets arising from concessional lease at cost or fair value upon initial measurement. And we have posed a number of questions on whether the current disclosures are appropriate. And again, if you look at those submissions that are publicly available, I think there was a general support for those proposals in not-for-profit private sector. Board decided to defer that decision on whether to make that accounting policy choice permanent or not at this stage for not-for-profit public sector until other projects or outcome of other projects are being considered, namely our local fair value measurement project that we are aiming to issue exposure draft shortly, as well as AASB leases project phase 2, which is looking at concessionary leases. That feedback, as an outline, will be considered by the board at April meeting as well. So post-implementation review, as we already mentioned a couple of times, this project has been a great way to kind of kickstart and inform the post-implementation review, in particular for 1058 and 15. However, we are, as you may have seen from our work program, we are about to embark on a number of post-implementation reviews across our domestic standards and significant amendments to international standards for Australian entities. And this is in line with our policy to perform those post-implementation reviews normally after 2 years of operation of the standard. So the process really involves asking questions to stakeholders, what works well and what doesn't work that well, and then board will consider that feedback. How do we go about it? Obviously, it's talking to people like yourselves, attending this webinar through various means, roundtables, discussions, etc. We also look at available research and outcome of that research to at the very start of the process to give us some pointers. And as I mentioned, yeah, this project was great confirmation of the feedback what we have been hearing for quite a while. So it's great that we are not starting from scratch with the PIR. So we want to use this opportunity to ask for your expression of interest, whether you would be willing to talk to us on one-on-one basis or whatever shape or form is preferable to you to help us with the with this post-implementation review. So I will put up the poll if technology skills will not fail me. Before I will do that, I'll just draw your attention to that privacy data collection notice we have on a slide that outlines how I will use and how I will not use your personal information to make sure that I did all things that I needed. So I will now open the poll and we'll give 30 seconds for participants to answer. So I think poll is hopefully open and I can see answers starting coming through. I'll give you maybe another 20 seconds, and great to see that people are interested to help us with the post-implementation review. Okay, maybe 10 more seconds to give opportunity people answer who did not yet. Okay, I will be closing poll now, and thank you for those to put up their hand, and obviously thank you for all attending to this webinar. It's great to see so many willing us to help us, and the post-implementation team will be in touch in coming weeks to arrange the form. We can interact, and obviously, as I mentioned, based on that feedback from the post-implementation review, the board will consider next steps, which may or may not include any standard setting action. Other avenues are, for example, educational material, exhibitional examples, etc. So stay tuned for this one. Moving on to next slide. We just highlighted here or included a couple of links to the hopefully useful sources. Again, the STAB FAQs included on our website, and key facts document that we already mentioned under the hot topics. We haven't included a link, but it's a reminder of something what already Carmen mentioned, that entities, when consider requirements of the standard, there is an Appendix F, which was issued really to help Australian entities, not-for-profit entities, to implement 15 illustrative examples. Should be helpful source of guidance too. And I don't expect everyone to read basis for conclusions, but if someone has a particular question, the basis for conclusions are a useful source to see what was board thinking and why they made the decisions they made. This slide highlights and provides overview of all resources, or probably majority of resources you can interact with us. I will just highlight a couple of elements, and probably the first one I would do is the new weekly news alert, and I including a link there. I think that's the most efficient way how you can stay up to date what we are up to here at AASB, and you will see it in your inbox every week on Thursday afternoon. And the other thing is YouTube channel where you can find recordings of our webinars. So I think that's a useful resource too. And then everything else, including Australian accounting standards that are there available free of charge. And I think with that, I will hand over back to Nicole to see whether we have any Q&As we want to cover, whatever we have time left. Thanks.
Thank you, Freddie. So that does take us to the end of our planned agenda, but we do have a few minutes left, and there's a few Q&As that have come in that I'd like to ask Carmen and Freddie, as we've got a few minutes left now. Also, for those participants who haven't asked a question that maybe you've got still a question to ask, pop that into the Q&A now, and we'll hopefully get to that in the last few minutes. So we've got sort of a group of questions around enforceability. So probably over to you, Carmen. The first question relates to the concept of enforceability. Is it, is it a matter of the fund provider's ability to enforce rather than the NFP as the fund receiver's ability to enforce?
Yeah, absolutely. So it's the person who is providing the funds, whether they have the ability to enforce. We actually want the not-for-profit not to be able to determine that, because if they can determine it, it's not an enforceable contract. So it's all about whether the fund provider can enforce that contract.
Thank you. Where there's an agreement to deliver a service and we've got enforceability established via a refund clause, so for example, and then funding is not spent or a performance obligation is not met, and then the performance obligations are delivered for less than the funding provided, perhaps. At what point is the unspent funding recognised? So third party has agreed in this case that it can be kept. At what point would that entity be able to recognise that funding?
So I guess if the third party has agreed that you can keep that money, I would be recognising it at that point. If you finish what you need to do and you're kind of hanging and you don't know whether I'm going to be able to keep it or not, well, that's where it becomes more to a judgment call. And often we put through an acquittal process, and it's when that acquittal process is complete that it's finished and you can then keep it. There's also no harm in asking the fund provider, we haven't spent this. You have to tell them anyway you haven't spent it. So getting that answer, particularly if you're creeping up to your year end, and this could be a material amount for you.
Thank you. Another one somewhat related to that. So you mentioned about a customer being a fund provider. So if we've got a collaboration agreement or arrangement, such as a research project where it's funded by an organisation who also has an expert working on the research project in collaboration with the party, but where the project output or material doesn't flow directly to the funder, but the outcomes and publications, for example, do have value to that provider. Does that mean that the counterparty is not a customer because they're also participating in the research?
So this is probably another one of my depends answers. It depends on the terms and conditions. We do have a fair amount in the standard that deals with research projects, and there is a number of staff FAQs that deal with research projects. There's no such thing as the generic research project. It seems to be that there are all sorts of weird and wonderful terms and conditions, and how much is the fund provider collaborating and what else are they providing. So unfortunately, I'm not going to be able to answer that one other than to say, have a look at the guidance that's out there. It really depends on the terms and conditions, whether they are the customer or whether they are acting in some sort of collaborative joint arrangement.
Thanks, Carmen. And Freddie, one for you in terms of termination for convenience, point of clarification around how we account for termination for convenience. And the question is whether they're accounted for in AASB 9 or another standard. I don't know if you wanted to touch back on that point again.
Oh, well, I can touch on that point, but I'm afraid I'm not going to give a conclusive answer. And an answer I would probably can't give is it could be. But as AASB board decided that the answer to this topic would have to be probably referred to the interpretation committee, because those clauses are present in for-profit contracts, and it's definitely not for myself to interpret accounting standards.
Thanks, Freddie. And Carmen, another sort of follow-up question around performance obligations. So the question is, have we not found that entities are coming up with potentially artificial performance obligations that aren't really the overriding purpose of the funding? So for example, research funding, where you've got the objective of the government funding to be innovation, and so the funding is really given to enable the entity to carry out the research. It isn't given for the outcome or the output of the research, even if there are IP clauses or intellectual property clauses that would suggest shared ownership of any output. And I'm not sure if it's a question or a comment, but the last part of the question is, we've got AASB 1058 seeming to force us to say that the IP is the performance obligation itself. I don't know if you want to comment on that one.
So I guess there's probably two elements to that question. Do I think that we're seeing artificial performance obligations? No, I don't. I think what we're seeing is people are actually starting to have to think, what are we actually being given the money for? And it comes down to that level of discretion. And I think from taking a AASB hat off for a minute, thinking of it from a governance perspective, if anybody's giving you money and you don't know exactly what you're giving them back for, I think that can cause some issues in an entity. So I think I have seen entities have really focused more on, okay, we're being given this money, what do we have to do? And a performance obligation is about that performance of goods or services. If I link it back to the second part of the question, which is about research, research is challenging, and we understand that, and alluded back to the comments I've just made about the research grants. I think it can be hard to work out what are we actually being paid for, and innovation is something that's wonderful, and can we do that? But if you can decide which research you're being innovative on, then potentially there isn't those performance obligations. So research is challenging. I do accept that. But I don't think we are seeing artificial performance obligations generally.
Thanks, Carmen. That's all the Q&A that we have outstanding for today's webinar. So we've now reached the end of our content for today, and I'd really like to thank everybody who attended today's webinar for your time and participation. Thank you for your interaction and your questions throughout the webinar. It's very much appreciated. You've now got the contact details for myself, Carmen and Freddie, so please reach out to us with any feedback or comments. AASB staff are always very keen to hear from you and greatly appreciate any and all feedback that you may have in relation to this area. So thank you again for your participation, and we'll close the webinar there and enjoy the rest of your day. Thanks, everyone.